Your portfolio drops 12% in 3 days. Your stomach tightens, heart races. You open your trading app compulsively. Every hour becomes a ritual of checking losses. Sleep escapes you. That voice in your head screams one command: sell everything. Now you know this feeling. Most investors do. What happens next determines your financial future. Some people surrender to panic. They sell at the bottom. They watch from the sidelines as markets recover without them. Others, a smaller group, pause. They implement a simple framework. They protect their wealth. The difference between these two groups isn't intelligence. It's not access to better information. The distinction lies in understanding one biological truth. Your brain actively sabotages rational financial decisions during market stress. Let me share what neuroscience reveals about panic selling and how you can override this destructive pattern. Your brain contains an almond-shaped structure called the amygdala. This ancient part evolved when our ancestors faced predators on savannas. The amygdala scans constantly for threats. It triggers your fight-or-flight response within milliseconds. Here's the problem. Your amygdala cannot distinguish between a charging predator and a declining portfolio. Researchers at institutions, including the University of California, discovered something remarkable when studying individuals with amygdala damage. These rare patients showed dramatically reduced loss aversion compared to healthy participants. Why? The amygdala generates that overwhelming fear of financial loss. Scientists found that the amygdala implements a biological mechanism for inhibiting actions when outcomes seem potentially harmful, a response expressed powerfully in monetary decisions. During market downturns, your amygdala hijacks the prefrontal cortex, your rational decision center. Blood flow shifts. The primitive brain takes control. You stop thinking strategically. You react emotionally. This isn't weakness, it's biology. Research by psychologists Daniel Kahneman and Tversky demonstrated that losses feel psychologically twice as powerful as equivalent gains. Losing $10,000 inflicts roughly double the psychological pain of gaining $10,000. This asymmetry drives irrational behavior. You'll hold losing positions too long, hoping they recover. Then, when fear peaks, you'll dump everything at precisely the worst moment. Think about the 2020 pandemic crash. Markets plummeted 34% in weeks. Headlines screamed catastrophe. Lockdowns triggered extreme uncertainty, resulting in massive market decline caused by panic selling among many investors. Those who sold in late March locked in devastating losses. Those who maintained their positions or purchased more recovered within months. Your amygdala doesn't care about long-term wealth, it cares about immediate danger. Understanding this biological reality represents your first defense. Let me walk you through the emotional stages investors experience during market stress. Recognizing these phases helps you interrupt the cycle. Stage 1. Vigilance. Markets begin declining. You notice you check prices more frequently. Anxiety builds quietly. You're not panicking yet, just monitoring closely. Your amygdala starts activating. Stress hormones trickle into your bloodstream. Stage 2. Rumination. Prices continue falling. You calculate losses obsessively. Sleep becomes difficult. You discuss the market constantly with friends. You consume financial news voraciously. Each headline confirms your fears. Here's what research shows. Even incidental emotions unrelated to specific decisions can influence loss aversion during financial choices. Fear from pandemic news, political uncertainty, or personal stress amplifies your market anxiety. These emotions stack. Stage 3. Paralysis. The market drops sharply. Your losses mount. You freeze. Should you sell? Should you hold? Every option seems wrong. You second-guess constantly. Your prefrontal cortex attempts rational analysis, but the amygdala overwhelms it. Stage 4. Capitulation. You surrender. The emotional pain becomes unbearable. You sell, often at the bottom. Relief floods through you momentarily. The bleeding stops. Stage 5. Regret. Markets stabilize, then they rise. You watch from the sidelines. The recovery happens without you. Regret replaces fear. You miss the rebound. This pain can equal or exceed the original loss. Studies document that among behavioral biases driving panic selling, loss aversion and regret aversion prove especially influential. You feared further declines. You anticipated future regret. Both emotions pushed you toward destructive action. A recent examination of investor behavior involving nearly 190,000 participants found something telling. Nearly 1 in 10 respondents fully or partially panic-sold stocks during market volatility. This isn't rare behavior. It's common, but it's also predictable. And predictable means preventable. Numbers tell the story clearly. During the 2008 financial crisis, markets dropped approximately 57% from peak to trough. Devastating. However, investors who sold during the panic and remained in cash for just the best 10 recovery days missed out on substantial gains. Those who stayed invested throughout the entire crisis period eventually recovered and prospered. Historical analysis of market crashes and speculative bubbles highlights how cognitive biases such as loss aversion drive significant market distortions. These distortions create buying opportunities for disciplined investors. Consider this reality. If you invested $10,000 in a broad market index at the 2008 peak and held through the crash, your investment would have multiplied several times over by 2020. If you sold during the panic and waited for safety, you likely never recaptured those gains. The mathematics of loss prove unforgiving. A 20% decline requires a 25% gain to break even. A 50% drop demands a 100% return for recovery. Selling locks in losses. Staying invested preserves the possibility of recovery. Yet understanding mathematics doesn't prevent panic. Your amygdala ignores spreadsheets during crisis moments. You need a different approach. This framework requires 5 minutes to implement but provides lifetime protection against panic selling. Step 1. Create your decision protocol right now. Before the next market decline, answer these questions in writing. What specific percentage decline in my portfolio triggers a review? Not action, just review. Perhaps you choose 15%, perhaps 20%. The number matters less than having one predetermined. What evidence would justify selling a position? Write specific criteria. Has the company's business fundamentally deteriorated? Has your investment thesis proven wrong? Has your time horizon changed? Notice what's missing. Market declines aren't listed. Price movements alone rarely justify selling quality investments. What will I do during the next market crash? Write this sentence. When markets decline 20% or more, I will pause all selling decisions for 72 hours. I will review my protocol. I will contact my advisor if needed. I will not make reactive decisions. This simple commitment creates a circuit breaker. Your future self, the one flooded with cortisol and adrenaline, needs this guidance from your current calm self. Step 2. Implement the 5-minute pause. When panic strikes, when that voice screams, "Sell," you activate this sequence. Notice your elevated heart rate. Acknowledge the fear. Name it. My amygdala is activating. This is biology, not reality. This simple act of recognition shifts processing from the amygdala back toward the prefrontal cortex. Research demonstrates that fear of financial loss activates fight or flight responses in the amygdala identically to physical danger. Naming this truth diminishes its power. Pull out that document you created. Read your predetermined criteria. Do current circumstances meet them? Usually they don't. Market volatility rarely changes fundamental investment theses. Will this decision matter in 20 years? Most market declines, even severe ones, represent mere footnotes in long-term investing. The 1987 crash, the 2000 dot-com bubble, the 2008 financial crisis, all devastating at the moment, all eventually overcome. 20 years from now, will you remember whether you sold during this particular decline? Probably not. Will you remember if panic selling destroyed your retirement security? Absolutely. If you still feel compelled to sell after these 4 minutes, commit to waiting 72 hours. Schedule a specific time to revisit the decision. Research emphasizes that maintaining diversified portfolios and adopting long-term perspectives helps investors navigate fluctuations effectively and avoid succumbing to panic selling during volatile periods. 3 days allows cortisol levels to normalize. It permits rational analysis to resume. It creates space between stimulus and response. In my experience working with investors, fewer than 5% follow through with selling. After implementing this delay, the acute panic passes. Rationality returns. Your brain employs mental shortcuts called heuristics. These shortcuts helped our ancestors survive. They sabotage modern investors. Recency. Bias. You assign disproportionate weight to recent events. 3 consecutive down days feel more significant than they statistically merit. Your brain extrapolates: if the market dropped 5% this week, it must continue dropping indefinitely. This bias proves particularly dangerous. Consumer confidence influences stock markets, driven by herding behavior and optimism or pessimism during downturns. When everyone expects further declines, panic spreads rapidly. Herding behavior: you look to others for cues during uncertainty. If your neighbor sells, you question your own judgment. If financial media advocates defensive positioning, you feel foolish staying invested. Research into cryptocurrency markets, highly volatile environments, reveals something instructive. Investors fall prey to social pressure and market sentiment rather than performing fundamental financial analysis, with herding behavior driving price bubbles that appreciate beyond actual value before suddenly collapsing. Traditional markets exhibit similar patterns during crises, though typically less extreme. Disposition effect: you sell winners too quickly and hold losers too long. This tendency reverses during panics. Analysis shows that during crises, loss aversion overpowers the disposition effect. Investors sell losers more aggressively than winners, driving panic. Understanding these biases doesn't eliminate them. Your amygdala doesn't care about behavioral finance theory during 3 a.m. panic sessions, but awareness creates possibility. You can recognize bias in action. You can interrupt the pattern. Financial resilience requires more than knowledge. It demands emotional preparation. Practice, thought experiments. Before the next crash, visualize it. Imagine your portfolio declining 30%, feel the discomfort. Then mentally rehearse implementing your protocol. Athletes call this mental rehearsal. Musicians practice difficult passages slowly before performing at tempo. You can rehearse emotional discipline before market stress demands it. Automate your investing. Remove discretion during volatile periods. If you invest monthly in retirement accounts, continue those contributions regardless of market conditions. This automation prevents paralysis and panic selling, dollar cost averaging, purchasing fixed amounts regularly. Naturally buys more shares during market declines. Your anxiety decreases when you're automatically taking advantage of lower prices, limit information exposure during market stress, reduce financial media consumption. Each alarming headline reactivates your amygdala. Each expert predicting doom reinforces panic studies. Examining the 2020 pandemic found that negative media coverage of economic fallout heightened fear among investors, contributing to widespread panic selling. Check your portfolio once weekly, maximum during turbulent periods. Review your protocol, then close the apps. Trust your predetermined strategy. Build your knowledge base, study market history. Understand that corrections occur regularly. Bear markets represent normal investment cycle features, not anomalies demanding action. Since 1950, markets have experienced corrections, 10% declines, approximately once yearly on average. Bear markets, 20% declines, occur every 3 to 5 years. Knowing this historical pattern provides context during contemporary declines. Develop a support system. Identify someone whose judgment you trust, not someone who will validate panic, someone who will remind you of your long-term strategy. Someone who will ask, does this decision align with your protocol? Many investors benefit from professional advisors who provide this behavioral coaching during volatile markets. The value isn't market timing expertise, it's preventing emotionally driven mistakes that destroy wealth. You've absorbed the research, you understand the biology, you've learned the framework, now comes action. Today, right now, complete your decision protocol. Write those specific criteria for portfolio reviews. Document your commitment to the 5-minute pause. Save this document where you'll access it during future market stress. Share your protocol with someone who will hold you accountable. Your spouse, your advisor, a trusted friend. Tell them, if I call during the next market crash wanting to sell everything, ask me about my protocol. Consider this perspective. Research demonstrates that monitoring behavioral sentiment indicators can serve as early warning systems, complementing traditional fundamental analysis. You can track your own emotional states as data points, not definitive signals. Schedule periodic reviews, perhaps quarterly, to revisit your investment thesis. Ask, have fundamentals changed? Has my time horizon shifted? Has new information emerged that genuinely contradicts my original analysis? These scheduled reviews prevent reactive decisions. They create structured opportunities for course corrections based on logic, not panic. Remember that building wealth requires decades. Market declines represent temporary setbacks within longer trajectories. Your retirement funds have 20 or 30 years to grow. That nasty 20% correction? Mathematically insignificant across 3 decades. Markets will decline again. Perhaps next month, perhaps next year. Certainty eludes us regarding timing. But this truth remains absolute. Your response to that decline will determine your financial future more than the decline itself. Recognizing behavioral biases' impact on market dynamics emphasizes maintaining diversified portfolios and long-term investment perspectives. This recognition transforms abstract knowledge into protective action. Panic selling destroys more wealth than market crashes. The investors who capitulated during 2008, 2020, or any previous crisis forfeited the recoveries that followed. They transformed temporary declines into permanent losses. You possess a different option. Your 2-step framework, decision protocol plus 5-minute pause, requires minimal time investment. 5 minutes of preparation today, 5 minutes during the next market crisis. Those 10 minutes can save decades of wealth accumulation. Your amygdala will activate during the next crash. That's biology. But your prefrontal cortex can maintain control. If you've prepared properly, write your protocol. Now, practice your pause. Build your resilience. The next market decline approaches inevitably. The only question, will you react from fear or respond from preparation? Consistency trumps complexity in investing. This simple framework provides that consistency, protection against your own worst impulses during difficult moments. Implemented today, your future self will thank you when markets test your resolve, because they will test it and you'll be ready.